Pacific. Our guest host for this hour, Yu-Dee Chang, Principal and Chief Advisor at ACE Investment Strategist. He is joining us live from Washington, D.C. What do you think, Yu-Dee? We've got a conference call taking place between the G7 finance ministers and the heads of central banks. It sounds like they're getting ready to seriously take some action. Are you expecting anything from this conference call?
Yeah, you know what, if you think about it, of course, they always say that, but the bottom line is it's tough. You know, you think about Europe, whether it's the austerity measure, or U.S., the stimulus packages you were just talking about, that's only one side of the equation. The other side of the equation is revenue. So we still need world economic growth in order for the world to pull out this mess here. And we just don't have that. That's where the problem is, especially recently. We're hearing the resurgence of European debt crisis. We're hearing the slowdown of the U.S. economy, and we're hearing the slowdown of the economy in China. So all these concerns, I think eventually is going to still, hinder this market, hinder this world economy
I'm going to jump in for just a moment here. We'll get back. Hold your thought. We'll get back to you in just a moment. We're going to go live to Canberra now. We have some breaking news down there. The Australian Treasurer, Wayne Swan, is giving a news conference on the Australian economy. Let's listen in.
Fundamentally broken following the revelations in Four Corners last night.
I'll leave those matters for the responsible minister.
The revelations last night on Four Corners.
Well, I'll leave those matters for the minister and the federal police. I'm dealing here with matters pertaining to the global economy, the Reserve Bank board meeting later today. They're my sole focus, and that's what the Australian people would expect.
When you just said then that this government has a proven track record in dealing with global instability, when asked if you'll go into deficit, does that mean that is a consideration for this government?
I'm not going to deal with
the global economy deteriorate further?
Well, I'm not going to deal with hypothetical situations. I make the point that we do have a proven track record in dealing with global instability. This is the point that has been made by Mr Parkinson and others, but we don't deal with those hypothetical situations. It is not the responsible thing to do.
When Ms Swan looked at that hypothetical and looked at these comments by the head of Treasury and said that if we don't reach that surplus, we could be at risk of losing our AAA credit rating. Surely that's something you're considering.
Can I just make this point, and this will be my final point. Australia, for the first time in our history, has the gold-plated AAA credit rating from the three major global rating agencies. So when I say bringing the budget back to surplus provides a buffer against global uncertainty and gives maximum flexibility to the Reserve Bank, that's a real live example of why our goal, given our growth forecast of coming back to surplus, is so important. Thanks.
Okay, that was the Treasurer in Australia, Wayne Swan, there speaking from Canberra, talking about how important it is to bring the Australian budget back to surplus and making the point that they do have a proven track record in dealing with global instability. Obviously, Treasury officials, finance ministers from around the world are concerned about what's unfolding on the macro front. And remember, we do have an RBA meeting later today. The market pricing in 80% chance of a 25 basis point rate cut. Some are calling for 50 basis points, so we shall see what unfolds on that front and where the Aussie dollar will go from here as well. Let's get back to Yu-Dee Chang from ACE Investment Strategist. Yu-Dee, we've been talking about Australia quite a bit lately. Let's pick up on this theme. Australian bonds, anything dated longer than 1 year, hitting record highs. Do you think that's a good move for investors if they're looking for perhaps a better yield than U.S. Treasuries?
Well, that's where the problem is, right? I think the concept of risk trade is still there. Everyone's looking for yield, and there's just no yield anywhere to be getting. So I think that's why money is floating to where the slightly higher yielding instrument is. But I think this problem, going back, is still this growth problem in the world, which we just simply don't have. You know, it's kind of interesting. I'm actually in the U.S., right? So let me tell you a personal story. It's kind of interesting story. We're talking about China here. I have a friend who actually works for a Taiwanese companies operating out of China. What they do is they do exit strategies for other Taiwanese companies in China. He tells me for the past 3 years, on the average, there's about 2 companies, Taiwanese companies, going to them asking for exit strategies out of China. There's about 100,000 Taiwanese companies in China. So the past 3 months, he tells me, that number has increased to about 20 companies per month going to them because they see dismal growth of China.
So
no growth in China, of course. Exactly, and that's where the problem is. There's
Okay,
no
so-
global growth.
No global growth and incredible risk emanating from Europe as well. But what's your advice to investors who were betting on higher Treasury yields? I mean, we're back to 1.5% on the 10-year, but boy, they just seem to keep on trending down.
Yeah, I think for the time being, it looks like there's still momentum left, that people wanting to go to safety, that's why they're buying all these treasury, whether it's US or Australian. So on the very short-term basis, actually our technical analysis work tells us treasury yield probably is going to go head down even lower. However, I think on a slightly longer term basis, I'm definitely not in the camp that rates will be much higher in the near term, foreseeable future. But again, I don't necessarily think at this point in time the Treasury has too much upside to go. After all, we're joking around saying how low can rates go? Zero. So my read on the Treasury market over the short term, there's a little bit more to go. But over the intermediate term basis, just not too much upside, although not too much downside either.
Well, they're negative in Germany, so you never know. Thank you so much, Yu-Dee Chang from ACE Investment Strategist, joining us there from Washington, D.C. Now, remember, if you have a question for Yu-Dee, shoot us an email. The address is squawk@cnbcasia.com. You can also get me on Twitter @LisaCNBC. Very closely. Let's get back to our guest host now. Yu-Dee Chang is Principal and Chief Advisor at ACE Investment Strategist, joining us live from Washington, D.C. What do you think, Yu-Dee? We just heard Adam going through the data. Overall, it's been slowing, sort of losing some of the momentum we had earlier in the year. And not only that, some of the previous numbers are getting revised downwards. Do you think the risk of a double-dip recession is back on the table?
You know what? I think the talk of that is definitely back on the table. People are actually giving about a 25% chance now that we will double dip. Personally speaking, I really do not think so. I think if you think about it, Lisa, coming into this year, or even last year, the growth projection has always been varying somewhere between 1.5% to about 3.5% on the upward for the U.S., but basically ending somewhere right around 2%. I think that's where we are. It's a very benign growth. We're not in a double dip recession. There are still some positive factors in the economy, but the super growth with some excitement in the early part of the year is just simply not there. So I think we're still in this the tale of two cities. There's a lot of problems, potential pitfalls in the world, in the economy, yet on the other hand, there's still some bright points. So buy low, sell high. We're joking around saying, well, everybody knows that, but that's the actually thing that you should do in order to be successful these days.
Yeah, it's hard to buy this low, right? It's scary.
Yeah, I know that quite well.
Not easy to do.
Yeah,
Right.
not easy to do. That's correct, especially when you want to get the timing right. But I mean, we've seen such a massive sell-off in equities across the board. Are valuations looking compelling at this stage to be a little bit more adventurous, or should investors keep their powder dry?
Well, I think it depends on what stocks and what sectors. I think overall speaking, if you look for the past 2 years, basically we're in the same pattern. We had a good beginning of the year, 2010 and 11 for that matter, and this year 12, and we pretty much gave it all back in the month of May. Sell May, go away, and this is what happened again. The difference is the prior 2 years, after the May sell-off, the market S&P had a valuation of somewhere around 14 to 15, and right now the PE on the S&P is about 14. So this year we're actually having a better valuation at this point in time as opposed to the past 2 years. So you know what, seriously guys, I think I hold my guns to what I just said. I really believe on dips, I actually want a dollar cost averaging buying into the market. On rallies, I actually do not want to get carried away. I want to.
Okay, it looks like we've lost Yu-Dee. We're going to do our best to get him back. That's the beauty of live TV. You just don't know what's going to happen right out. It can go either way. So they're going to try to see if we can get Yu-Dee back in just a couple of minutes. And they're working on it right now, but hopefully he's making some valid points about dollar cost averaging your way in, because it's very difficult to jump into the market and use all your patterns.
It really does depend on the timing, I think, when you're dollar cost averaging. That's important, and what your time frame is.
Yeah,
anyway,
let's get back to Yu-Dee right now. We've got him, apparently we've got him back on the line, Yu-Dee. Thank you so much for sticking around. We lost you there temporarily for a second. I want to ask you, were making the point that this year the economic data and the flow of the market has sort of tracked the previous 2 years, and you're saying it's a good time to start dollar cost averaging in. But let me put this to you. The last couple of years, investors have gotten absolutely killed in the summer months. So they're thinking, hey, the first part of the year, it all looks the same as the last couple of years. So how do we know the summer's not going to be absolutely brutal? Yet again, what's different besides a more attractive PE ratio?
Yeah, no, that's a fantastic question. I think in my mind, don't forget the Fed put, or the Bernanke put, is still there, right? So that's why the talk of QE3. Although personally, I don't think QE works, but for the overall market is concerned, that so-called Bernanke put is still in the market, and the concept of risk trade is still there. At the end of it, people are still looking for yield, and there's just no place for yield. So eventually, when things stabilizes a little bit, money should return back to the market. That's why if you look, Lisa and Adam, if you think about it, market made a bottom in October of 2008. Basically, it started rallying in March of 2009, right? So during the stretch, the market didn't go straight up. We actually had numerous corrections back, on the average about 8.5%. So at least it has proven after the 2008 debacle, buying low is the way to go.
Okay, we are almost out of time. Thank you so much, Yu-Dee Chang from ACE Investment Strategist. He is our guest host. He's going to be here for the rest of the hour. Shoot your questions to squawk@cnbcasia.com. Still very VP of Retail Sales and Marketing for Greater Asia for Microsoft. And also with us is our guest host for this hour, Yu-Dee Chang, Principal and Chief Advisor at ACE Investment Strategist, joining us from Washington, D.C. Alan, you kick this off. Tell us exactly how smart glass improves the Xbox experience.
Well, first of all, we're here in Los Angeles, and Microsoft kicked off the big E3 conference this morning, and the first thing we showed before we showed Smart Glass was the new release of Halo 4, the phenomenal blockbuster game on the Xbox 360. But of course, we're extending beyond just gaming into the entertainment space. And so with the announcement of Xbox Smart Glass, it really opens up an opportunity to bring Xbox to multiple devices, not only on your Xbox console, but also on your tablet, on your PC, and also on your phone.
Alan, that's a very interesting development, and I noticed that some of the entertainment that you're offering is pretty much sports related. I'm sure Lisa next to me is going to be watching basketball and hockey. What other sort of entertainment will you be offering on these devices?
Well, of course, we've really extended our entertainment offering over this past year to include movies and music. Movies, of course, are really a great source of entertainment for people, and being able to get that on your Xbox platform now through these devices, through Xbox Live, really opens up that opportunity. But of course, it's not all about entertainment, and it's not all just games. One of the things we did introduce at E3 today was the new Nike Plus fitness program. And so that's something that extends beyond the gaming audience, really to introduce one of the great global sporting brands with really the greatest entertainment brand in Xbox, and bringing that together so people can do more than just gaming, but add fitness to their portfolio of activity.
Yeah. Do people really use that, or is it like a gym membership? You get excited about it, you buy it up front, and then you use it for a week and you give up on it? Does that happen with some of these Xbox fitness apps?
Well, actually, yeah, that's interesting. I think, look, previous ways of integrating fitness into technology hasn't always been great. But we think with the partnership of these two great brands coming together with Nike Fitness and Xbox 360, we really think that we've got something there that really makes getting fit and fitness for people that really take that seriously.
Okay.
We really think we've got something great integrating that technology with your Xbox.
Okay, Yu-Dee, jump in here.
Yeah, Adam, Adam was joking around saying that, well, he's going to have it watch some sports and work it off on the fitness. But again, I guess, Alan, the question to you is this. To me, actually, it's really like Microsoft and Apple fighting for the control of my living room, of my family room. So, you're one step ahead of Apple. So the question to you would be that, what competitive edge do you really think that you have over the potential of the release of that ITV there?
Well, look, over the last 7 years, our install base for Xbox 360 has grown to be the #1 selling console platform in the world. We're not only on a worldwide basis were we #1 this year, but we're also #1 in Asia. And we think that that's a particularly powerful position for us to be #1 on Xbox in Asia this year. We've grown our live business about 35% this year, which means we have a lot of customers in Asia that are playing Xbox. They're paying members of Xbox Live, which means that the entertainment offering that we have is very rich. It's very exciting. It gives people access to movies, music, and games. And I think that gives us the big competitive edge.
Yeah, I want you to put a number on that for us, Alan. I mean, I know you're hoping Smart Glass is going to boost Xbox sales, but what are your specific projections in percentage terms?
Well, we don't forward project. We've sold 67 million consoles since we launched Xbox. We've added 40 million live customers to our Xbox Live membership. But the other thing that's interesting in terms of transforming this business from just gaming into entertainment is that we've sold nearly 20 million Connect sensors. And I think last year when we talked on the program, we talked a lot about this new technology. We've really transformed entertainment into multiple dimensions. It really exposes people to a lot of different types of entertainment experiences. And I think that's the thing that gives us the differentiation.
All right. Well, unfortunately, we are out of time, but thank you so much for explaining Smart Glass to us. Alan Bowman from Microsoft, and we're going to be back with Yu-Dee Chang from ACE Investment Strategies in just a couple of minutes. All right. Jörg Kiener is Managing Director and Chief Investment Officer at Swiss Asia Capital. He is joining us now here at the SGX. And still with us, our guest host, Yu-Dee Chang, Principal and Chief Advisor for ACE Investment Strategist, and he is joining us out of Washington, D.C. Thanks to both of you for being here today. Jörg, let's kick it off with you. We've got central bank governors, finance ministers from the G7. They're holding a conference call. What are you expecting?
Look, I think what we're looking for this month is the preparation for the next round of monetization, quantitative easing, and we're going to see that out of the United States. We're going to see that out of Europe. So the whole West is basically looking at cushioning the downturn in the economy. In China, we already started. I think the $2 trillion program, which has been implemented, is already pointing to addressing the weakness in the economy. What is this going to mean
for commodity prices in general?
Basically, it's going to mean overall that currencies will rebase down quite fast. That's why gold jumped quite aggressively on Friday. And I think commodities will start their bottom building process and moving back up selectively. First, the ones which have huge shortages first, and the ones which not great demand supply imbalances a bit later.
Okay, Yu-Dee?
Yeah, I think it's kind of interesting that we see the weakness in commodity. I think the question to you would be that how much of that, the weaknesses in commodity prices recently, is attributed to the weak economy of the world, and how much is attributed to the resurgence of U.S. dollar?
I think that's very difficult to quantify. I think the dollar is a very big indicator, basically, on commodity prices. Interesting to see is that gold moved despite the dollar rally, and it basically starts showing that even there we see a segregation of movements to the past. The economy as such is certainly one thing, but I think the key issue is money now. The economy is second.
But, there's still a lot of opinions out there that say that, the economic conditions in the U.S. may not warrant further quantitative easing because we're not going to get our bang for our buck. If we don't see further QE out of the U.S., but potentially we do out of China and Europe, what would happen to the commodities complex in that scenario?
I think people are dreaming, because we have today something like $1.4 quadrillion worth of derivatives, according to the BI status, before they mix the numbers. We've got about $70 trillion of derivatives on JP Morgan spoke. I think the share price been down 3% last night. 50 trillion out of that is interest rate derivatives. So if you stop quantitative easing, your derivatives market will go haywire. Your fixed income market is going to go belly up. Your spreads on credits will balloon. You can just about forget about almost any recovery globally. So I don't think there's very much option today than quantitative easing, and I don't think governments will do anything else than that. I think they've proven for the last 10 years, each time the going gets tough, we print money.
So what happens when you can't ease anymore? It sounds like, based on that logic, the entire system will collapse.
You will get confetti money, basically, right? If the money becomes worthless, people will start moving into some tangibles which they think will remain their value.
So the fiat currencies are no longer viable, is what
Then
you're
they
saying.
will not be longer viable. And in that case, what you want to own is probably food. You want to have agri-land. You want to have anything you need basically to survive, because your money is going to debase at the speed of what we've seen in Argentina or Latin America during the
Yu-Dee, I
crisis.
want you to jump in on this. Do you agree with what Jörg is saying, that if we don't get more quantitative easing from the Fed, all of the derivatives being held by financials is going to be a lot of trouble out there in the market? Do you agree with that take?
Well, I agree with him, the fact that if Fed doesn't ease, there's going to be a lot of problems. But I think on the other hand, there's actually a lot of consideration on the other camp too, where U.S., don't forget, is coming up to the election. People say, well, the Fed has to consider extra. Do they really want to, at this point in time, use fiscal policy to affect the possible outcome of the election? That's number one. And two, QE2, I'm in the same camp. I don't believe QE2 even works. So if QE2 didn't work, why should we even continue with QE3? And three is the fact that I'm in the camp saying that, well, let the economy work itself out. If it has to bottom out, it has to bottom out first before it can rebound. So I'm actually in the camp opposed to QE3, believe it or not.
All right. Okay. Thanks to both of you. Goodbye to Jörg Kiener from Swiss Asia Capital, who was talking about commodities, and our guest host, Yu-Dee Chang of ACE Investment Strategies. We'll get the final word in just a couple of minutes. As we go, all right. Good morning. Welcome back to Squawk. Let's get final thoughts from our guest host, Yu-Dee Chang of ACE Investment Strategists. Yu-Dee, there is a growing expectation out there that we're going to get action, perhaps coordinated from central banks around the world. What happens to all of the money parked in the bond markets? It's getting riskier to be in treasuries, isn't it?
Yeah, no doubt about it. I think on a short-term basis, if we do get that coordinated effort, the bond market is probably going to sell off and money is going to return back to the risk trade, thus the stock market. That's why I'm actually in the camp saying that, there's actually a risk to the downside. There's actually potential upside risk, meaning that if you miss it, you miss the market. That's why I said a little bit earlier, probably picking the right sectors and start dollar cost average yourself into the market. Give you one sector that's kind of interesting. It's the so-called discounted variety sector, such as Walmart, such as Target. Believe it or not, last month, S&P was down 6%. This sector was actually up about 4.5%. It's a very defensive sector. So I think maybe on some stabilization, picking the right sector, picking some good stocks, taking part of the money, dollar cost averaging is the way to go.
Yu-Dee, but if you think about it, when the markets rallied off the lows last time from last year, it wasn't the Walmarts and the Targets that were rallying. It was the growth-sensitive stocks and the banking stocks, the financials. And I wonder how worried should we be if the bond market is treating companies such as Morgan Stanley, their bonds at junk territory? What's going on there in the financial space?
Yeah. No, I agree with you. Financials to me is not an investment opportunity. Financials to me is exactly what you said. They are a trading vehicle for now. On top of it, if we still have a lot of uncertainties with the U.S. Dodd-Frank so-called regulations. So the visibility of the financial sector to me is not clear at all. So you can't really treat them as a good investment vehicle, but only a trading vehicle.
Okay, thank you so much, and goodbye. Thanks for being our guest host over the past hour. Yu-Dee Chang, Principal and Chief Advisor at ACE Investment Strategist, joining us from Washington, D.C. Well,